Hi, everyone. Welcome back. This is another edition of Wade into Wealth. We are glad you're along with us as we continue this journey to financial wellness. And I'm Chuck Wade, joined here by my brother Ethan. As always, well, at least up to this point every time. We haven't had one where one of us has had to fly solo yet. Tax season. Let's start with that. The deadline is fast approaching.
Monday,
April
the 18th.
18th. It's not the 15th, closed for the Good Friday holiday. So the 18th, you have an extra day to get your stuff done.
And your IRA contributions for the prior year, 2021.
Traditional and Roth IRAs are
SEP.
due.
Yep.
SEP, all of those things are due on Monday, April 18th. So be aware of that if you're listening to this podcast. And I know there are a few of you that we will be going down to the wire to do our contributions. But that's not what we're here to talk about today. We're going to talk about the fact that a recent article in the Wall Street Journal came out that said in the past 6 months, the population over 55 that have been retired, nearly 0.5% more of those folks have felt the need to go back to work. And as we do this, my chair is sinking. So I'm going to adjust that.
Yeah, it's on a percentage basis, not a lot.
No.
But it's 500,000 people. That's
a
good
big
amount.
number, and it's a bigger number than we've seen in some time. Now, some of that may be pandemic related, and the fact that in many ways things have started to shift closer to normal than they have been in the last couple of years. I think you have people seeking social connection. I see that with clients that go back to work on a part-time basis that are retired, just looking for something to do. However, I don't think those are the big reasons. I think it's inflation right now seems to be the culprit here, and the fact that there has been a significant increase in just about everything. Fill your car up.
I mean, even just gas alone would be a reason to go get a part-time job. Yeah.
Right. There's those things. There's gas, food. Everything has a higher price tag associated with it right now. It doesn't appear that relief is imminent. And so we're seeing people start to go back to work. That made me start to think, what we talk about this with clients. We talk about it on a fairly regular basis. Inflation proofing to the best that you can your investments and strategies that can be taken to move towards that.
I mean, it's easy when inflation is running at 2% or less, like it has been for the better part of a decade. But when it's running closer to 6, 7, 8%, it's much more of a challenge. And it's not as simple as just generating more dividends or getting higher income paying investments. In some ways, it means you have to transition the way you've been investing from perhaps just generating income to focusing on a little bit more growth over time to help preserve your purchasing power.
Yeah, and I've had that conversation with several folks, and the reality is that in this business and as people, we have to be willing to accept that we can't always do stuff the way it's always been done just because of that caveat. We've always done it this way. Well, the reality's been, for a lot of folks investing for income, that interest rates have been so low that where we would traditionally have a portfolio that has a lot of individual bonds in it, that has not happened. We have not bought a lot of bonds recently up until the last couple of weeks.
Yeah, right.
Because interest rates have been so low. So you have to shift the way that you're doing something. And that is the area that we're in now. And we can't necessarily look at just dividends alone as a way to generate enough income or growth over time to keep up with or stay ahead of inflation.
Well, because companies paying an 8 or 10% dividend often are not the highest quality.
No.
There's going to be little to no growth of that income. But when you look at the S&P 500 since the 1940s, average annual rate of return, probably close to 12% per year?
Well, the average return of the S&P 500 is 11.5%. So
yeah, close to 12. And that beats inflation for you over time.
Mm-hmm. It beats it at 2%. It beats it when inflation is at 8%, which is where the most recent numbers just came out at.
But you have much more potential for growth over time, but it also will change your risk profile.
Sure.
And you're going to feel the ups and downs a little bit more. And it's also not to say that you have to go 100% stock, but shifting your focus a little bit from just income towards a more long-term growth strategy is going to come with more volatility, but that increase in volatility will often also come with a pretty nice reward over time.
It's such a subjective term, risk.
Yeah.
Risk,
it's different for everybody.
Safe,
Yeah.
I mean, these are all terms that get tossed around. I hear it all the time. Well, I want something with not a lot of risk. Well, that is something that's totally different to every single one. To you and I, that is different in our own lives. But risk is subjective. So what is the concern? What is the fear? Are you afraid that something is going to zero? It is going to lose all of its value? We talked about it in our last podcast, the cost of investing. It's not necessarily a dollar amount. It is fear. It's anxiety, it's uncertainty, and potentially regret. Those are the true costs, and we have to be willing to approach those a little differently with a scenario like this. And what we're not saying is take your entire portfolio and put it into an S&P 500 index fund or just put it into growth mutual funds.
Right.
That's not what we're suggesting in this. But in many cases, it has been taking a portion of a client's assets, maybe it's 10 or 15 or 20%, and shifting that from just dividends and interest to a little more of a broad focus on appreciation over time.
Yeah, I think it was the chairman of our firm, George Comboy, when we were new advisors, would always say you have two glasses of juice in front of you, the growth juice and then the income juice. Mm-hmm. And if you want a little bit more growth, sometimes you have to pour some out of the income glass and vice versa. They're not mutually exclusive. But you will have to give some up in order to reap the benefits of what the other provides over time.
Yeah, so that's really important to keep in mind, and those are conversations that we have. But the other focus with this, with looking at it from income, if we shift that a little bit, is, well, how do we find income that is able to increase over time?
Yep.
Typical retiree or someone who's retired, if you're collecting Social Security, that doesn't typically increase very much. Although the most recent one, you get the cost of living increase.
That just means your bills are higher, so it's not necessarily a net increase to your income.
If you have pension income, pensions are fixed. Fixed income investments, things like bonds and preferred stocks, those typically are fixed as well. So
hence the name fixed income.
There it is. Good detective work on
You're welcome.
on your end there, Sherlock.
Yep.
However, dividend-paying companies is very often the most sustainable way to have a stream of growing income with respect to your investments. How do we do that?
But not just any dividend-paying company.
No.
It tends to be your more mature businesses that have stable cash flow and very consistent revenue and earnings over time. I mean, I think of your Procter & Gamble's of the world. This is not a recommendation to buy Procter & Gamble stock. Compliance Officer Lori.
Thank you.
But it is one, it's a great example because I believe they've increased, Procter & Gamble makes
over
Bounty
65
paper towels,
years.
Old Spice deodorant, Charmin toilet paper, the list goes on, Swiffer, blah, blah, blah.
Yeah.
But they've increased their dividend for more than 65 years in a row. And oftentimes, dividend growth companies who have consistently increased their dividend, or what are referred to as aristocrats, if they've increased their dividend for more than 25 years in a row, tend to be one of the best hedges against inflation. Because that increase in the dividend payment that you're getting will help offset some of the inflationary pressure that you may see, but it also comes with an investment that gives you the opportunity and the potential to appreciate in value over time as well.
Yeah.
So you get two components of potential growth there.
And the thing that tends to make these somewhat beneficial is that if you go through and look at periods of crisis, turbulence in the markets, periods when the markets have have fallen, concessions, recessions, what's the other word? Corrections. I couldn't think of it.
Concession. Yeah.
It's the Red Wings opening day. I'm thinking of a hot dog. I'm thinking of my Schweigel's Red Hot and a White Hot. I like to get one of each. Ketchup on the red, mustard on the white. That's, just a shift. But
only red hot dogs for me with ketchup.
It's a good day for a hot dog.
Yep.
Yeah.
Yep.
And so you said many years ago on a family vacation in Toronto when I wanted to slap you because you're being so annoying. But that's for another day.
Got a hot dog, though.
You did get a hot dog.
It was a good hot dog.
You did. Dad finally just relented because you're being so annoying.
If he had just done it earlier, it would have been much easier for everybody.
This is true.
It's his fault.
Well, sure. Typical of you. Shift the blame elsewhere.
I also remember on that trip, I think you were getting yelled at in the bathroom of the
sure I was.
aquarium or the zoo, and I was probably like 8, 10 years old. I don't know how old I was. All of a sudden I look around, no one's there except me, because Dad was just yelling at you in the bathroom for whatever it is.
I think it was the aquarium. I think it was the Ripley's.
It was the aquarium.
Yeah.
I thought to myself, how am I going to get home? I don't know where anybody is.
Yeah.
You were just getting yelled at.
That's what I do.
Yep.
Where was Mom?
I don't know.
Oh.
I probably saw us looking at the fish.
Looking at the fish.
I
Who
don't
only
know.
knows.
I don't know.
So to get back to dividends and what happens in periods of recession or corrections within the market, your investments go down. They drop in value. Procter & Gamble, Johnson & Johnson, these companies are not immune to that.
Mm-hmm.
But what has happened, if you look at these and evaluate them during these periods, you actually see clients who hold these kinds of investments, while the value of their portfolio has dropped for a period of time, their income, the income generated, increases over those years, depending on the investments that they have.
Sure.
If you have those groups of investments that will increase your dividends over time or consecutively or consistently on an annual basis, even when things are upside down a bit, it's very likely that the stream of income provided by their dividends increases.
Well, sure. I mean, if we pick Procter & Gamble again, 65 years in a row means they increased their dividend in the pandemic, 2020. They increased it in 2008, the financial crisis. They increased it in 1987. So, but that's why it tends to be mature businesses with consistent revenue.
Yeah.
The companies who cut their dividend first are the want-based businesses. Right. Think of Disney. Think of General Motors, Ford. Mm-hmm. We all want to go on vacation. We all want a new car. We don't need it.
Right.
And when things are tough, we don't have to make those purchases, yet we still need paper toweling.
Right.
We still need toilet paper, and hopefully we still need soap and toothpaste.
And those are also the companies. They're not exciting.
Nope.
Those lists are not exciting, but it's very typically companies that make a product or a service that we know and use. Walmart's another example. Walmart's grown its dividend very consistently. McDonald's is another example. Now, we're not telling you to go out and buy these, but these are companies that you can go Google dividend aristocrats, and you'll get a whole list, and you'll probably recognize,
You're gonna recognize a lot of them.
And some you won't recognize, but you would probably be familiar with what they do or the sector in which they operate. So that is and has been one of the most efficient ways to keep up with inflation.
In simple terms, boring is a pretty good long-term investment strategy.
This should not be exciting. Nope. It shouldn't be, and that's the whole point. We don't need exciting. We need consistent.
Yep.
What about fixed income investments? So this is a side effect of inflation is that we've seen interest rates go up. Significantly. If you're buying a house, we are nearing the end of the process on the construction of our home, and I'll tell you what, the interest rate's a lot higher than it was 6 months ago.
Yep.
It is what it is.
Well, the 10-year Treasury, which is kind of in some ways the benchmark interest rate that everything else is sent off of, is up more than 100% in the past 3 months.
Right.
We look and say, well, from 1.3 or 1.4% that it started the year, meaning if you gave the U.S. government money for 10 years, let them borrow money from you for 10 years, they would pay you 1.3 or 1.4% interest every year. That's gone up to 2.7% now.
Yeah, it's a big jump.
That's more than 100%.
And everyone else bases their interest rates on that. So if you have a variable credit card, that's gone up. If you have
everything,
any kind of loan that's a variable loan, boom, it's going up. If you go to the bank to take out an auto loan, it's more expensive than it was 3 months ago.
But you know it hasn't gone up? What they pay on bank savings.
What they'll pay you on their savings.
Yeah, they're a for-profit business.
Not how it works.
Nope.
But as a byproduct of that, we have started to see something that we have not seen in a handful of years, is that yields on individual bonds and some fixed income investments are starting to increase as well.
Yeah, the interest rates are much more attractive now, which is a benefit for investors. You don't look at it and think, I'm happy interest rates are up and I'm paying more everywhere else I am. But from an investment side, interest rates have also gone up and you're able to generate some more income there.
Yeah, what that means is that as interest rates rise, the price of fixed income investments fall. They have an inverse relationship. So corporate bonds that maybe 6 months ago were paying you like 1.7% for like 4 years.
Yep.
Now
they're playing north of 3.
We're seeing over 3.
So let's take a step back. What is a bond?
Yes.
A bond is similar to a mortgage for a house. So you're building a house, and so you went to the bank and said, we're going to build a house for this. And they said, we'll lend you that money. You pay us this interest rate and pay us principal back over time. A bond is the same scenario, except you, the retiree or the investor, is the bank. You're lending money to corporations. Maybe they want to build a call center or whatever it is that they're doing, trying to raise cash for it. You will lend them money. It's a contractual obligation that they have to pay you interest and your principal back over time. It's the same circumstance. It's called fixed income. Even before you make the investment, you know what your return is going to be off of it. Yeah. Very boring. Yeah. And it's not the key driver of returns in your portfolio, but they are meant to serve as a buffer for when everything else is not doing well.
Yeah. And, I would, from conversations you and I both had with clients, with a bond that pays a 3% return over 3.5 years is a lot more attractive than 1.75%
absolutely
over that same period of time. And it is a little more attractive when we're saying this is your stability here. This is the foundation. We know the income's going to be consistent. So, that has changed as well. There are also, fixed annuities. We see these every once in a while. Rates have moved somewhat higher with these. So if you want a guaranteed return for a period of time, you may be able to get a better rate on fixed annuities. What about variable annuities? We see those from time to time as well.
Yeah, I suppose the rates on those probably are getting a little higher, but the internal costs on those probably, in our opinion, still are not enough to outweigh the gimmicks that are inside of some of
they
those
can be really, really confusing and quite costly. So, but they're out there. But with any of these investments, you want to make sure you know what you have or ask questions of how does this work?
Yeah, and simple is better.
Yes.
If someone's coming to you with an idea that has all these bells and whistles and needs 8 things to go right in order for it to be considered a success, sometimes when things are too good to be true, when they seem too good to be true, they are.
Here's a question I would ask. World. How available is my money to me? If I wanted it back, if you have a bond and you decide, I need some money, I need to sell this bond, you can sell it for whatever the market price is on those bonds. There are some products that will have a period of time. You cannot take the money out or take your investment out without facing a penalty.
Or a surrender charge.
Yeah, not something we love.
No.
Not something we love. So simple's better. Companies or investments that operate in a sector or make a good or product you know and use. And I think this is the most important thing. There's no trick to beating inflation. There's no magic wand that can be waved, and neither you nor I have a magic 8-ball on our desk yet that tells us how to do it.
It's just based on your strategy and if you're willing to adjust the times.
And there doesn't need to be. So if this is something that you would like to have a conversation about, you can find us, Wade Group at Brighton Securities, at Wade Into Wealth on all the various forms of social media. And we will continue next week with another episode of Wade Into Wealth.
Let's go. Yeah.